and welcome to our financial model and valuation exercise that we're going to be conducting together. In this exercise, we're going to go through a variety of different pieces of analysis, all of which I hope are going to be exciting, meaningful, and of value to you. The first tab in this model that we're going to be filling up together is going to be the Assumptions tab, followed by the Financial Statements, for which we will be populating the projections for the projected period of 2023 till 2027. These are calcs that we're going to be doing. And this is the valuation that we're going to be conducting together, a DCF valuation, and another leveraged buyout valuation, which we're going to be going through together. These are the comparable companies that we're going to be using, and this is where it's all going to come together in the Output tab. The company we are going to be conducting this exercise for is entirely hypothetical. It is called Purple Glory, and before we do anything, I'm just going to save this file as a working file. So Purple Glory is a major producer and distributor of Purple Glory products in the United States, sells 3 products, A, B, C, low cost, medium cost, high cost. We're going to assume 3 key scenarios that will drive financial projections: a base case, an upside case, a downside case as well. So column R is where all the assumptions are for the base case, the upside case, and the downside case. And all we're going to do in this tab is populate the model. Years 2018 to 2022 are actual years, and the figures have already been plugged in here from the audited financials, and we're assuming we had management discussions. This is a switch that is going to enable us to pick one of the 3 cases: a base case, an upside case, or a downside case. Pretty straightforward. I'll even show you here how we build the switch like this. But first, let us just start filling these assumptions based on the comments in column R. This is all straightforward. If anything seems confusing, all you have to do is revert back to the completed file, which has been uploaded, and you'll see all the formulas. For selling expenses, I'm saying a 10% reduction versus 2022A, and then I'm just dragging everything to the future. Pre-tax percentage of pre-tax income for taxes is 30%. We're assuming for the base case a dividend payout ratio of 10%. We're saying a 1% increase for capital expenditure, for CapEx. And for depreciation, we are taking the average of the 3-year historical figures and then keeping that constant. We're saying we're going to notice in the base case an improvement in how long it takes to collect receivables from customers, as well as improvement of 5 days compared to the historical average of how long it takes to convert inventory, as well as an improvement. But in this case, it's an extension, it's a delayed payment of 5 days as far as accounts payable. So we're saying it's going to take us 5 days longer to pay suppliers, and they're going to be okay with it. And now for the upside case, 3% increase in prices, same for volumes sold, and I just drag that for the entire forecasted period. Control R is what I use as a shortcut. A one-time 5% improvement due to efficiencies on my gross margins. This implies that I'm getting the cost of goods sold for a specific product down because of efficiencies that I will incorporate in the upside case for the projected period. 20% reduction, so multiply that by 1 minus 20%. No change in tax rate. Dividend payout of 30% here. This is up from 10% in the base case because we're saying this is the optimistic scenario. We're going to be paying the shareholders more money because the business is going to be doing really well. In line with the 3-year historical average, just take the average and then keep constant for the projected period here. And now for working capital, this is going to get even better because it's the upside case. So we're saying faster payment for receivables from clients. So it's going to take us 7 days shorter to collect money from clients. It's going to take us 7 days shorter compared to the 3-year average to convert inventory to cash. And it's going to take 10 days longer to pay suppliers. And this is definitely going to help our cash position compared to the base case. And in the upside case, we're also saying, because we can afford to do so, we're going to pay 20% of whatever excess cash we have to accelerate the repayment of debt. And now the downside case. This is the worst case scenario that we are assuming. We're saying 0% for price increases, and we're going to sell less volume. So it's a 2% contraction for all 3 products. No improvement in gross margins, so they're going to be exactly the same. So no efficiencies here, no ability to reduce cost of goods sold for products. G&A, general and administration expenses, are going to be in line with the historical average. Same for the selling expenses. Tax rates also going to be equal. No dividend payout here. We're not going to pay any dividends in the downside case. And just Control R, just fix that. Keep these assumptions constant for the projected period. CapEx is in line with the 3-year historical average, so just take that average and keep constant. And same. By the way, these could be rolling averages, which means that every year, say like 2025, you can take the average of 24, 23, and 22. It really doesn't matter. Whatever you think makes sense for the industry is fine. For working capital here, I want you to notice a key difference. We're saying now it's going to take longer in the downside case to collect money from customers. It's going to take longer to convert inventory to sales. And it's going to take the same average of time to pay suppliers. So suppliers are not going to be helping us here, and clients are going to be giving us a harder time. So it looks like in the downside case, something bad is happening in the market. And now, how do I pick which case I want, and how do I feed the right assumptions to the rest of the model? I'll show you that in a minute. So this is a list here. So I'm just showing you how I build it, and essentially you just list the different scenarios here. Just copy them. And let's say I create a drop-down button or a drop-down list. And all I have to do is go to data validation and click on list. Put the source. Okay. And now on the front end, I have something that looks like a drop-down list. When I put these figures in white, they would still work, but when I delete them, then the list is gone. So I always need to make sure I hide the data source somewhere that is safe so that the list is always working. So now I want to work on the back end. So what happens? What I want to happen is when I select any of the 3 cases for this section 2 here, is for the button to just pick the assumptions that are in line with the case that I've selected. And the way I'm going to do that is using something called an if statement. And I want you to think about this for a minute with me. So the way the if formula works is if something is true, then spit out something. And if it's false, then please give me something else. So I'm going to structure it in a way that says if E30 is base case, then pick L75. If it's not base case, then it could be either upside case or downside case. So then I'm going to say if it's upside case, pick the assumption for the upside case, the 3% price growth for product A. And if it's not, which implies it is downside case, then pick the downside case assumption, because there's really only three ways this could go. It could either be an upside case assumption, a downside case assumption, or a base case assumption. And now let me test it. Let me just change the cases, and looks like it's working. Downside case, 0%. That is right. Let me just fix that thing here. Let me just fix that little thing. And now all I'm going to do is simply copy, paste that formula, because any reference to cell E30, which is the selected case, is frozen. There are dollar signs around the E and dollar signs around the 30. I just press F4. And so now every time I copy that formula, the reference remains intact. Just fix the working capital format. And we are now in good shape to start selecting different cases. Look at how it changes as I change the desired scenario. It is picking up all the assumptions I've just populated below for the base case, the downside case, and the upside case. I'm just doing a quick check, making sure all these assumptions in the selected case are picking up the right assumptions from the right scenario. And now I will start linking the selected assumptions to the financials tab so that I can start projecting my financials into the forecasted period. So I just link, and my assumption on the financials tab, because it's linked to another sheet, per the color code, is going to be in green. So now I can start forecasting my projected prices. And what I'm going to say for the first year and every forecasted year is that new price is equal to old price times 1 plus the growth rate. Same for the volume. And now all I have to do is just copy that formula here, and it'll link to the right cells. There you go. And I select all and Control R. Do a quick check. Yep, that looks fine. 3%, 3%. And now I just want to calculate gross sales or revenues. And the way I go about it is I just copy the formula that I've already done, which is price per product A times products sold, so volumes, plus price of product B times volumes B, plus price of product C times volumes C, will give me total revenue or gross sales. And percentage growth is also a formula. And now, to pick up the gross margin assumptions, just link to the right cell for the right product. And notice the jump in the gross margins here because I am working with the upside case, saying that I'm going to be, in my best case, more efficient, and I'm going to be able to make more margin from each product by reducing my costs and increasing prices. And so the total product sold here is exactly what I have in my revenue buildup. So I'll just link that cell to the cell above and Control R. Same for products B and C. And now I'm going to calculate my cost of products A, B, and C. Starting with product A, it's price of product A divided by 1 plus my gross margin. That is the formula. It is a reshuffling of the formula because gross margin is revenue minus costs or gross profit divided by revenues times 100. And now I'm going to do the same for product B. So cost of B is price of B divided by 1 plus gross margin of B. And for product C, price of product C divided by 1 plus gross margin of product C. Just drag this, Control R, and now calculate the total cost of goods sold, which is cost times volumes. And gross profit is simply gross sales less cost of goods sold, but cost of goods sold are already negative, so I just add my gross sales and my cost of goods sold line items, and margin is now just gross profit divided by gross sales. There is an increase in my gross margins. And now for the remaining expenses, just keep doing exactly the same thing, just making sure that I'm picking up the right assumptions for the right case. And G&A expenses now are a percentage of revenue. So I just take the assumption of 11.9% times gross sales and drag that across. That looks fine. And do the same for selling expenses, which is also a percentage of revenue. Drag that across, and now I can calculate my Ebitda, my earnings before interest, taxes, depreciation, and amortization. And now the Ebitda margin is simply Ebitda divided by sales. Now for the depreciation line item, I'm going to use something called a base formula in my Calc tab. And we will be working on that Calc tab in a minute or two. But for now, I'm just setting the formulas here so that everything is flowing in the way it should be. Financing costs are also one of the items that are going to be dealt with at the end. Link my tax rate assumption, and I can calculate, or I can at least put the formula in so that when the highlighted line items are populated, the tax rate will automatically update itself. And I'll just drag this or copy the formula or hit Control R on my keyboard and copy these formulas again. Calculate margins. Linking the assumption for dividends. And I could also start linking everything here so that when everything is populated, the formulas will update themselves automatically. And I'm saying my retained net income, the formula for that is total net income less dividends. That is the line item that I will be discussing at the end. But for now, we can start thinking about the balance sheet projections. CapEx, depreciation, and working capital are all going to be influencing my ending figures on my balance sheet. This line item we will worry about in a bit because we need to finish the cash flow statement as it is linked. So my ending cash every year is my beginning cash plus my net change in cash, which is derived from my cash flow statement. So property and equipment is a base calc, and we will be doing these calculations on the Calcs tab for both property and equipment and working capital shortly. So base stands for beginning, add, subtract, ending. So for every year in my projected or in my forecasted period, my beginning balance for each year is simply the ending balance of the prior year. Just linking the assumption here. And I remind you that because it's linked to the background and assumptions tab, that assumption is shown in green. And now I'm linking my assumption for depreciation. So my CapEx is a percentage of sales. So I'm going to go to 2023 here, take the sales item, and multiply that by my assumption of 2.2%. And this figure, for the purpose of this base calculation, is going to be a positive figure because this is simply saying that the more I invest in plant, equipment, and machinery, the more my fixed assets are worth. And depreciation is going to work in the other way. So whatever my equipment is depreciated by, this figure is going to eat into my ending balance for my fixed assets. And then the beginning balance for next year is linked to my ending balance of this year. And I just Control R, I just drag the same formula. And that was my base calculation. And now that I've solved for my depreciation in my Calcs tab, I can just pick that up. And now I can link my ending balance for each year to my workings in the Calcs tab. And I can start solving for a working capital here. I'm taking the long way here to solve for working capital because I think it's important that we go through this exercise together. So I'm going to start by solving for or reverse engineering from my historicals, even though I already have these figures, just so that I can go through the thinking process around working capital because it can get a little confusing at times. So I am just linking here my historical figures for accounts receivable, inventory, and accounts payable. And I am saying that my working capital is current assets minus current liabilities, or accounts receivable plus inventory minus accounts payable. And what I need to do as far as my working capital is concerned is keep an eye on the change in working capital. So when working capital, the general rule is when working capital goes down, because working capital equals to current assets minus current liabilities, when it goes down, that decrease is a influx of cash. It's a source of cash. And when it goes up, that means you are spending money. Now I'm just linking the gross sales and the cost of goods sold because I need to solve for my working capital days. And these are all formulas. I'm going to assume I have 365 days per cycle. And then I'm going to take my accounts receivable, divide it by my gross sales, and multiply that by my days. And these are my accounts receivable days for my historical period. Inventory days are calculated based on cost of goods sold, because think about it, you are buying inventory from your suppliers. And so take my inventory, divide that by cost of goods sold, this doesn't have to be negative, and multiply by 365, and drag that for the entire historical period. Same for accounts payable. So I take accounts payable, this is what I owe suppliers, divide by COGS, my cost of goods sold, times my days assumption. And these are my working capital days for my historical years. I'm just showing you how these were derived, but I've already done the assumptions for that working capital here. And for the selected case, the improvement as far as receivables and inventory and payables are concerned are reflected in my projected period. And now I'm going to use these assumptions and my projected gross sales and my projected cost of goods sold to forecast my working capital by using that formula, just reshuffling it. So I'm saying my accounts receivable are my days divided by 365 times sales. That is a decrease in accounts receivable from 2022 to 2023, which is going to be a source of cash. You have less money owed to you by clients in 2023 than in 2022. So you have collected some cash. Same for inventory. It's gone down. It's a source of cash. And for payables, based on costs, these have gone up. But the change in 2023 is impressive, obviously because of our assumptions. These are not actual results. We are just assuming this is going to be happening. But in 2023, I have a positive change in my working capital. I have a source of cash, and that is because I had a big decrease in working capital year on year. So now I can start linking all these figures I've solved for from my Calcs tab and set the formulas up as well. That's for accounts payable here. Just copy some formulas. This is going to be fed from my debt tab, which I am yet to work on, and same for the long-term debt item. Copy some more formulas here so that I have my balance sheet up and running. Total equity formula, net assets, balance sheet check. The balance sheet always has to balance. This always has to be 0. And obviously, it is not the case right now because we have line items to fill. My retained earnings in the balance sheet is always linked to the income statement. So now you're going to start seeing how these financial statements are interconnected.